Good evening, guys. So today we are going to start this first session of advanced taxation practice to pass webinar session. So if I may give you an introduction about myself, I'm Rakita Jayatunga, representing Icon Business School from Sri Lanka, and I have been teaching advanced taxation for nearly 10 years now. So during this 5 days time period, so every day, if I give you the agenda for this session, if I may explain that. So we have 5 days, and every day we have 3 hours, and each day I will be discussing some important topic that will be relevant for your exam. So today I have selected the inheritance tax. Likewise, tomorrow I will be discussing main principles and issues pertaining to capital gains tax. And then on Wednesday and Thursday, I'm planning to discuss two main areas that fall within the category of unincorporated businesses, or rather individual income tax computation. So out of that, the two main areas you get under individual income tax computation is income tax, employment income, that I will be discussing on Wednesday. And then Thursday, I will be discussing principles pertaining to unincorporated businesses such as sole traders and partnerships. And on Friday, I will be addressing main areas pertaining to corporation tax. So anyway, we have a very vast syllabus compared to other subjects that we have. However, during this time period, altogether we have 15 hours. So during this limited time period, I intend to discuss the most important areas that can be tested at the exam. And I will be discussing few questions from the Kaplan revision kit during this time period. So anyway, we know due to COVID-19, our June exam got cancelled. Even March exam got cancelled. So we are going to have the exam hopefully in September. And I know some parts of the region, except for Sri Lankan students, the other parts of the region, I got to know that you guys are going to have a computer-based exam. But for Sri Lankan students who are listening right now, currently it has been indicated that they're going to have a normal classroom environment exam. So anyway, whatever the basis that they're going to use, whether it's a computer-based exam or paper-based exam, it doesn't matter. I will be using the platform dedicated for this purpose. And we know when we practice questions, I will explain that straight away. Now, if you want to practice questions on the platform provided by ACCA at the exam, it's available to all of you. What you can do is you can go to ACCA Global website. Let me show you that. So you can go to ACCA Global website, and there, when you go to ACCA Global website, because for most of you, you're going to have a computer-based exam for the first time. So then what you should do is go to ACCA Global, and then under students, you get study support resources, and then ACCA qualification. Then you can pick the subject, advanced taxation here. And you pick computer-based exams. And then you can see CDE practice platform. So you can log into this practice platform via your MyACCA account. So you use your MyACCA account and then you can log into practice platform. Ultimately, you will be directed to something like this. You'll be directed to something like this. And there you have the practice response options. One is the word processor. The other one is spreadsheet. So at the exam, when you're doing a calculation, you will have to use a spreadsheet. And this spreadsheet is somewhat similar to the Excel spreadsheet that you use in Microsoft, but you have to be very cautious here. If you are using the spreadsheet or the Excel sheet provided by Microsoft, now you can see this is the one that we are using. Actually, I'm spending some time on this because this is the first time you're going to face a professional level paper using computer platform. So only thing you have to be careful. Now the Microsoft Excel has so many features, but the platform that you're given at the exam does not have the same number of features. So I would recommend you to use this spreadsheet provided by ACCA when you're attempting questions, because if you get used to this, even though you are going to use this, sometimes I may use it for my convenience to explain certain things faster. But remember, at the exam, you don't get the same features provided to you here when it comes to the ACCA platform. So something that you need to remember when you are attempting questions at the exam, the spreadsheet will be given, but it is not similar to the Microsoft Excel spreadsheet given to you. It has limited number of features compared to the Microsoft Excel that we are having. So I hope that it is clear. And now here you can see you get the tax table. So a lot of other features are there. So straight away, you can get from here the exam instructions, everything provided to you. Then we have a navigator when you're answering a question. So from your next button, you can go to the next level. Likewise, you should pick the blank workspace. And then the spreadsheet. Okay, right. So familiarize yourself with this before the exam, so you have enough and more time for that purpose. Right. Now let me start today's topic. So as I mentioned previously, I intend to discuss inheritance tax. Now, when it comes to inheritance tax, the nature or the type of questions that you are going to get at the exam, what kind of questions you will be provided at the exam. Now, there is a higher possibility that you will be given or you will be tested with regard to inheritance tax and capital gains tax together in section A. In section A, now you have two questions, one for 35 marks, the second question is for 25 marks. So altogether, you can secure 60 marks. Then when it comes to section B, we have two questions, 20 marks each. So there's a higher possibility your knowledge pertaining to inheritance tax and capital gains tax will be tested in the first question. However, there are certain instances that they have given questions in section B for 20 marks from this area. And one more thing that you need to be very careful when it comes to inheritance tax. Inheritance tax, it will not be tested alone. Inheritance tax will always be tested along with capital gains tax. It will be tested along with capital gains tax. Okay. Now, A typical question at the exam, a typical question at the exam, a typical question at the exam now will state that you are required to explain capital gains tax implications. Capital tax implications. So in a typical question, they will mention that you are required to explain the capital tax implications. So when a question says there is capital tax implications, remember it is not restricted to CGT implications. It is not restricted to CGT implications, even though they mention it or not. If you are required to explain capital tax implications in a given question, you need to address both CGT implications and inheritance tax implications. Both CGT and inheritance tax implications. All right. Now, when it comes to inheritance tax, what kind of a tax is this? What kind of a tax is this? So let's look at that part. Now, ideally, inheritance tax is a tax that should be charged when a property is transferred on the death of a person. When a property is transferred on the death of a person, there should be a tax charge. It should be called inheritance tax. So that means on the death of a person, when you inherit something, when you inherit a property, there is a tax imposed on that. We call it IHT. However, people can manipulate the system if the tax is charged only on the death of a person. So if you are a very old person or else a sick person who's having a serious illness, then you may decide to transfer your assets, transfer your property to others prior to your death. So if inheritance tax is charged only on the death of a person, then there will be a problem to HMRC. That is, people may try to transfer their properties prior to their death to avoid taxes. Therefore, when it comes to inheritance tax, it is not a tax restricted to death transfers. It will be taxed even on lifetime transfers. It will be charged even on lifetime transfers. So for exam purposes, you actually need to focus mainly on IHT computation with regard to lifetime transfers. So first we'll look at lifetime transfers. During your lifetime as an individual, if you give something to another person, now an individual gives something, not selling. Inheritance tax is always charged on gifts. So during your lifetime, you give something to another individual. Then what do we call it? We call it potentially exempt transfer. There are mainly three types of lifetime transfers. When it comes to lifetime transfers, you get mainly three types. One is exempt transfers. The other one, we call it PETs, potentially exempt transfers. Then we have something called chargeable lifetime transfers. Right. Normally, during the lifetime of an individual, if you give something to another individual, maybe to your children, maybe to a friend of yours, so you give something and the recipient is another individual, normally it falls within the category of potentially exempt transfers. It falls within the category of potentially exempt transfers. Okay. The other situation is an individual giving something to a trust. There are different types of trust. You have a separate chapter on trust. Normally, it's considered as a complex area. However, in your syllabus, it is restricted and limited to only the basic principles with regard to trust. Anyway, you are aware that there are different types of trust. One is discretionary trust, and then we have something called interest in possession trust. Likewise, different types of trust are there. It doesn't matter whether it is a discretionary trust or IIP trust, interest in possession trust. If an individual makes a gift to a trust, then it is treated as a CLT. A CLT. Apart from potentially exempt transfers and CLTs, we have something called exempt transfers. Exempt transfers. So there are several examples that I can give you to address exempt transfers. For an example, there is something called small gift exemption. Small gift exemption. Now that is the situation where one individual gives something to another individual where the value is limited to £250 or less per annum. So if you give something to another individual, which does not exceed in value £250, or it's limited to £250 or less per annum, then it's completely exempt from exempt from inheritance tax. But if the value exceeds £250, in that situation, the full amount will be chargeable for the purpose of inheritance tax. Then we have another exemption. That is what we call marriage exemption. That is what we call marriage exemption. That is what we call marriage exemption. Now, by the way, if you want to download these documents, there are several documents uploaded to your handout section. So from there, you can download these documents. I have even uploaded some questions along with their answers that you can try at home when you're practicing questions for the exam. Anyway, now I was trying to explain there are several exempt transfers such as small gift exemption, marriage exemption. Marriage exemption, it depends on the relationship between the donor. The donor means the person who's making the gift and the recipient of the gift. So if the donor is gifting something to, if the donor is gifting something to his children when they are getting married, then up to 5,000, it will be exempt. And if the donor is party to the marriage, that means the bride or the groom is gifting something to the other partner, or else grandparents or great grandparents are gifting something to their grandchildren. In that case, up to 2,500, it will be exempt. Any other party makes a gift when two people are getting married. In that situation, up to £1,000, it will be exempt. Anything in excess will become chargeable. So during the first 1 hour, I will be explaining the principles pertaining to inheritance tax, and after that, I will be discussing some questions with you during the balance 2 hours time period. Okay, right. Now, another exemption that you can have when you make gifts out of your income as normal expenditure. Now, remember, inheritance tax is a tax that is charged on something called transfer of value. Is something that is charged on something called transfer of value, or we call it diminution in value, transfer of value. Now, unlike CGT, capital gains tax, Transfer of value is a different concept. Now, you know, when it comes to CGT, which we are going to discuss tomorrow, to calculate the chargeable gain, you need to get the difference between sales proceeds and the cost of purchase. That's how you simply calculate the chargeable gain. However, this transfer of value principle for the purpose of IHT is little different. Look at this example. Look at this example. Look at this example. Now here what you have to identify is, before making the gift, what is the value of your estate? Now assume this is your estate and your estate value says 200,000 pounds, 200,000 pounds. This is your estate value, 200,000 pounds. So before making the gift, your estate value is 200,000 pounds. Then you make the gift. Assume that this is the gift you made. This is the gift you made. This is the gift. Actually, you don't have to find out the value of the gift. It is not important at all. What matters is, after making the gift, then you have a remaining estate. This is the gift you made. When you make the gift, you are left with the balance estate. So you need to find out the value of your estate after making the gift. You make a gift. Before making the gift, your wealth is 200,000. After making the gift, your estate value has come down, say, to 160,000 pounds. So your estate, your wealth was 200,000. As a result of that, now your estate value or the wealth has reduced to 160,000. That means there's a diminution in value or transfer of value of 40,000. So basically, you are required to pay taxes on these 40,000 pounds. There are some deductions available. I'll come to that in a while. But this is how you calculate the transfer of value. Before making the gift, your wealth was 200,000. After making the gift, it's 160,000. So your wealth declined by 40,000 pounds, which is what we call transfer of value or diminution in value. Okay, right. Then you calculate your transfer of value in this particular way when it comes to lifetime gifts. So there are certain exemptions that I mentioned: small gift exemption, marriage exemption. And if you make a gift not from your wealth, not from your assets, but from your income as a regular expenditure, example, your father or else your grandfather is paying the school fees of his grandson or granddaughter. Now, in that case, I'll put it this way: the grandfather is paying the school fees of his grandson or granddaughter. In that case, if he's making that payment every month, and if he makes that payment not out of his assets, not out of his wealth, but from his income, in that case, that amount is completely exempt. In addition to that, there is something called annual exemption, which you must be familiar with. Annual exemption. Now, annual exemption is a situation every year, every tax year, you can claim 3,000 pounds as an annual exemption. So in the current year, you can claim 3,000 pounds. And if you have not made any gift in the previous year, in that case, you can carry forward previous year's 3,000 also to this year. So in general, in a given year, you can use the current year 3,000 pounds and any carry forward amount from the previous year. The maximum time period that you can carry forward any unused annual exemption is limited to 1 year. So if you have not used the current year annual exemption, you can carry forward maximum 1 year, and if you don't use it within that time period, it will be wasted. And one more thing. When you are using the current year annual exemption and the previous year annual exemption, you must always use the current year one first, and then only you should use the previous year annual exemption. Now, I always mention this in my classes, that is, IHT is a simple and straightforward area where you can secure full marks without any problem. Especially when it comes to computations, you can easily score good marks when it comes to inheritance tax. But the only difficult part that you need to focus on when it comes to inheritance tax is the usage of the nil rate band. Now, nil rate band is something given for a period of 7 years. So if you have made gifts within a period of 7 years within the nil rate band, then you will not be subject to inheritance tax. But if you have made gifts exceeding the nil rate band within a period of 7 years, then the excess will be subject to inheritance tax. Now, why this 7 years time period? Now, I told you, when it comes to lifetime transfers, we have mainly potentially exempt transfers and CLTs. Now, potentially exempt transfer is a situation, where one individual gives something to another individual, as I mentioned. So I'll quickly go through this because you guys are familiar with it. An individual gives something to another individual, then we call it a potentially exempt transfer. A CLT is a situation where an individual makes a gift to a trust. Any trust, it doesn't matter, you call it chargeable lifetime transfer. Then you need to understand the difference between a PET and a CLT. What is the difference between a PET and a CLT? The difference between a PET and a CLT. Look here. Now, a potentially exempt transfer is a gift made by one individual to another individual. Now, don't think too much about these two actually. Even though it's there, you don't have to make the situation complicated. These things exactly they have mentioned, they are not examinable. So in simple terms, remember, a potentially exempt transfer is a situation where an individual makes a gift to another individual, right? And CLT is a situation where an individual makes a gift which is not exempt or not a potentially exempt transfer. In other words, you make a gift to a trust, you call it a CLT. Then what are the tax implications? If it is a PET, there is no immediate IHT. IHT will only occur if the donor dies within 7 years after gift. So at the time of making the gift, there's no IHT. If the donor dies after 7 years, again no IHT. But if the donor dies within 7 years from the date of gift, in that case, there will be IHT. However, when it comes to CLT, there is immediate IHT. That is, at the time of making the gift, there is IHT. And there will be further IHT if the donor dies within 7 years from the date of gift. There's immediate IHT at the time of making the gift, And if the donor dies within 7 years from the date of gift, again, there will be further IHT, but there won't be further IHT if the donor dies after 7 years. So you can see when it comes to CLTs, since there is IHT at the time of making the gift, you need to calculate immediate IHT. You need to calculate immediate IHT. Immediate IHT. Okay? I know you guys have to listen now until I complete my theory part. Then after that, we can do some questions. But we'll get the basics right. If it is a CLT, there is immediate IHT. Then how much is immediate IHT? How much is the immediate IHT? How much is the immediate IHT? The immediate IHT depends on who is going to pay IHT. When it comes to pets, this problem will not arise because for pets, no immediate IHT. But when it comes to CLTs, there can be immediate IHT, and the applicable lifetime rate depends on who is going to pay taxes. Because either the donor, that is the person who's making the gift, or the donee, the recipient. Donee. Now, who's the donee here? The recipient of the gift. It has to be a trust. The person who's making the gift is an individual. The person who's receiving the gift, if it is a CLT, for sure, it has to be a trust. So if the donor has agreed to pay lifetime IHT, then the applicable rate is 25%. You just memorize it. It's easier. So if the donor has agreed to pay lifetime IHT, then the applicable rate is 20%. If the trustees of the trust who are responsible for the management of the trust, or the donee here, if they have agreed to pay IHT, then the applicable rate is 20%. And if the donor has agreed to pay IHT, the chargeable amount is always net figure. Again, something to memorize when you are doing the computations. You'll be able to understand this. But if the donor has agreed to pay, the chargeable amount that you calculate, is the net figure. But if the donee has agreed to pay, the rate is 20%, and the chargeable amount is then should be treated as gross figure all the time. Now, when you're doing a computation, you will be able to have a better understanding. So those are the lifetime rates, and again, there will be further IHT if the donor dies within 7 years, and there the applicable rate would be 40%. There the applicable rate would be 40%. Even if it is a pet, if the donor dies within 7 years, at the time of death, the gift will become chargeable, and the IHT will be taxed at the rate of 40%. We call it the death rate. However, a good news about lifetime gifts is that there are several reliefs available when you make lifetime gifts, especially here on the death of a person. Even though you're going to have inheritance tax if the donor dies within 7 years, you have a special relief called taper relief. You have a special relief called taper relief. So look at the taper relief available. Now, taper relief based on what? Taper relief depends on the time gap between the date of gift and the date of death. If the time gap between the date of gift and date of death is more than 3 years, you get the taper relief. Accordingly, you don't have to memorize this because the rates will be given to you at the exam. However, the rates will be, if the time gap between the date of gift and the date of death is 3 to 4 years, then it's 20%, 4 to 5 years, 40%, 5 to 6 years, 60%, 6 to 7 years, 80%. Obviously, if it is more than 7 years, no inheritance tax. So that's something available only on lifetime gifts. And when I'm explaining, there are certain things I must mention, the areas that you have to focus when you're studying. When it comes to inheritance tax, unlike other areas, you have to be familiar with inheritance tax computations. Whenever they are going to ask a question on inheritance tax, remember they will ask you to calculate the inheritance tax liability. Therefore, you cannot ignore the inheritance tax computation. You must be familiar with the full inheritance tax computation, especially on lifetime transfers at the time of making the gift and on the death of a person within 7 years. That can be tested most of the time. And another theory question that they have always tested at the exam, that is identifying the advantages of making lifetime transfers rather than making transfers on the death of a person. I can remember several times they asked this question. It's a very simple and straightforward question, but you can easily score good marks if you are given a question like that. That means identifying and explaining the advantages of making lifetime gifts rather than making gifts on the death of a person. Now, the main advantage that you can get when you make a lifetime transfer is that you can lock the value. Because it's like this. Now, I'm explaining several things which you will require when you're doing computations. But if you have any problem, you can always ask questions. There's a chat box. So in that case, whatever the relevant questions you can ask, if I don't get time to answer today, you can even email towards the end. I can give you my email address. So if you need further assistance and help in the future, you can always email. That had been the practice in the past. So I can explain, I can take my time to help you guys out. Right. So anyway, assume that you have made the gift, say in June 2000. Yes, yes, some questions are coming. Yes, I'm available on WhatsApp as well. So I can give you my number towards the end of the session. Yes. There's no WhatsApp group. I mean, I have a WhatsApp group for my Sri Lankan students, but not for others. But I can give you my number so you can ask whatever the questions that you have with regard to the subject. Within the time limit that I'm having, I will give my level best to answer those questions. So anyway, coming back to the topic. So say you made the gift in June 2000 and say 15. And when the value of the asset was £50,000, when the chargeable amount is £50,000, assume that he dies in December 2019. So within 7 years he has died, and assume that it is a potentially exempt transfer. Now here, now in June 2015, the value of the asset was £50,000. Say it's a land. And it's the nature when it comes to assets like land, the value will appreciate over time. So by 2019 December, say at the time of the death of the person, the value has increased to £80,000. Now, if you have gifted this asset in June 2015 during your lifetime, even though you die within 7 years period, your tax liability will be calculated on £50,000. That is on the value that existed at the time of making the gift. Now, reality is the value has increased over time. Within this 4 years time period, the value has appreciated. At the time of the death of the person, the value is £80,000, but your IHT liability will be calculated only on £50,000, not on £80,000. So they can actually lock in the value. Lock in the value, depending on the value that exists at the time of making the gift, even though the value has appreciated, you don't have to pay inheritance tax on the value which has uh, increased over time. On the increased value, you don't have to pay inheritance tax, even though the value has appreciated. But assume that you don't make the lifetime gift in June 2015, and instead you wait until you die to make the gift. In that case, you will have to pay inheritance tax on the value that exists at the time of your death, which will be 80,000 according to my example. That's the market value available at the time of death. Here, it's the value available at the time of gift, which is lower in value. So the market value which exists at the time of the death of a person, we call it the probate value. Probate value. Probate value means in a given question, if they have used the word probate value, then remember, it is actually the market value that exists at the time of the death of a person. So the main advantage of making lifetime transfers is you can lock the value based on the value that exists at the time of the gift. Even though the value is going to appreciate, you don't have to pay inheritance tax on that appreciated value. On the other hand, let's say the value has declined. There can be special circumstances, though it was expected an appreciation in value. There can be special circumstances where the value has declined. Say the value has gone down to 30,000 pounds. Now, in that case, even though you don't have to pay IHT if the value has appreciated, if the value has decreased over time, you get a special relief on the diminution in value. So you get the diminution in value relief if the value has declined after making the gift until the date of death. So you can see if the value has appreciated, you don't have to pay extra taxes on the appreciated value. But if the value has decreased over time, then on the diminished value, you can claim a relief, diminution in value relief. So you can see when you make lifetime transfers, there are so many exemptions available, annual exemption available, and then we have this special taper relief available. Now, someone has asked the question whether the taper relief available on CLTs. Yes, any lifetime transfer on that, you can claim the taper relief, not only on pets, but on CLTs as well. So I was trying to explain that when it comes to inheritance tax, spend some time to understand the nil rate band value calculation. If you understand the nil rate band value computation, that means you actually understand 80% of inheritance tax. If you understand the applicability of application of nil rate band, that means 80% of the IHT you have understood, because nil rate band value computation changes depending on the situation. I'll explain that as well. So let's look at those aspects. And some of you have asked certain questions, which I will be able to explain when I'm doing questions after another 15 minutes time. I intend to start doing some questions. So in that situation, we'll try to sort, we'll be able to sort most of the questions that you guys have asked. Okay, let's see. Now, this is the normal computation. This is the normal computation. Transfer of value. Then if there are some special reliefs available, such as small gift exemption, then marriage exemptions, then diminution in value relief, so you can deduct all those things. And then finally, you have to deduct the current year annual exemption and the brought forward or previous year annual exemption. Then you get the chargeable amount. Now this chargeable amount, whether this is going to be the net value, or the gross value, this chargeable amount, you have to figure it out whether it is as the net value or the gross value. Try to understand this. This chargeable amount that you get, it will be either net or gross. This is important. Now, there's a shortcut to remember whether it is net or gross. There's a shortcut to remember whether it is net or gross. For that, now, this chargeable value will always be gross. This value will always be gross if the gift is a pet. These are shortcuts to remember. Whatever the chargeable amount that you get will definitely be a gross figure if the gift is a potentially exempt transfer. When it comes to potentially exempt transfers, you will never get a net figure. You will always get a gross figure. But if you have done a CLT, if you have done a chargeable lifetime transfer, that means you have made a gift to a trust. In that case, the chargeable amount that you receive here will either be a net chargeable amount or gross chargeable amount. So how do you determine whether it's a net chargeable amount or gross chargeable amount? How do you determine whether it's a gross chargeable amount or net chargeable amount? It depends on the person who's going to pay immediate IHT. As I mentioned previously, if the donor has agreed to pay here, if the donor has agreed to pay, then he must pay inheritance tax at 25%. If the donor has agreed to pay, the chargeable amount that you get here will always be the net figure. If the recipient or the donee has agreed to pay the immediate inheritance tax at the rate of 20% in that situation, then the chargeable amount that you get here always will be the gross figure. It will always be the gross figure. So then you get the chargeable amount. If it is a potentially exempt transfer, since there is no immediate IHT, this will be the final answer. But if it is a CLT, after this chargeable amount, then you need to calculate the taxable amount by deducting the nil rate band available. Nil rate band available. The application of the nil rate band computation, I will explain it with a computation. That's the best way to understand this. Without doing a computation, you may not be able to understand the nil rate band computation. Okay. However, there are some important things that you need to remember with regard to the nil rate band. When you are calculating the available nil rate band for a lifetime that you have, lifetime gift that you have made, remember, you need to use the nil rate band available at the date of gift. You need to use the nil rate band available at the date of gift. And the applicable nil rate band for the relevant tax year will be given to you in the tax table. So there's no reason for you to memorize it. You just look at the tax table and identify the nil rate band available at the date of gift. So if you have made the gift in 2008-10-9, then the nil rate band available would be £312,000. £312,000. And from that, you need to deduct the value of any CLT here. Very important. You need to deduct the gross chargeable amount of any CLT that you have made within the last 7 years prior to the gift. So from the date of gift, assume the date of gift is 10th of February 2015. This is the date of gift. From the date of gift, you go back 7 years, that is 10th February 2008. 2008. Go back 7 years. And within this 7 years time period, if you have done any CLT, at this point, we never take potentially exempt transfers into consideration. You have made a lifetime gift. You look at the nil rate band available at the time of making the gift. And from the date of gift, you go back 7 years and you have to check whether you have made any CLT during that time period. You never consider pets, only CLTs. If you have made any CLTs within the last 7 years prior to the date of gift, and that amount you must deduct, only CLTs. You never take pets into consideration at this point. You never take pets into consideration at this point. And then what you should do is, you get the balance amount, that is the nil rate band available, and this you need to deduct from the chargeable amount that you will be able to see when you're doing a computation. And then the most important thing is how to identify the available nil rate band on the death of a person. How do you identify the nil rate band available on the death of a person on a lifetime gift? So it can be a pet, or even it can be a CLT, a pet, or it can even be a CLT. If the donor has died within a period of 7 years, if the donor has died within a period of 7 years, in that case, the pet will become chargeable for the first time. CLT will be having further IHT, so they become chargeable if the donor dies within 7 years. Again, you have to calculate inheritance tax, and at that point, you need to calculate the available nil rate band based on the nil rate band available not at the time of gift, but at the date of death. Now, for an example, according to my example, if you have made the gift on the 10th of February 2015 and you have died on the 15th December 2019, 15 December 2019, at this point, if it is a pet, it will become chargeable for the first time. If it is a CLT, there will be further IHT. That is because if you have died within a period of 7 years, in that case, you need to recalculate the nil rate band available at the time of death. In doing that, you have to always use the nil rate band available not at the date of gift, but at the date of death. Now, he has died during the tax year 2019-20. So when you are calculating the available nil rate band, you need to find out the nil rate band available at the date of death. At the date of death, not at the date of gift. Then you need to go back 7 years, not from the date of death, but from the date of gift. You are using the nil rate band available at the time of death. But to find out the available nil rate band, you need to go back 7 years. Not from the date of death, but from the date of gift. That means, like we discussed here, the date of gift is 10th of February 2015. You go back 7 years from the date of gift, that is up to 10th of February 2008. Now, in this situation, when you go back 7 years, you need to find out whether you have done any CLT during this time period and also any potentially exempt transfer that has now become chargeable due to the death of the person. So you go back 7 years from the date of gift, and within this 7 years time period, if you have done a CLT, don't think twice, take that amount into consideration. And within this 7 years time period, if you have done a PET, At once you can't take it. Check whether that pet is now chargeable or exempt due to the death of the person. If the pet is chargeable, you take it. But if the pet has now become exempt, as the donor has died after 7 years, if it is a completely exempt pet, in that case, you don't take it. And by deducting, then you get the new rate band available. So this is what you have to do when you are doing a lifetime transfer computation. It is extremely important for you to understand this computation. That's why I took my time, because most of the time at the exam, you have to deal with this IHT computation. Okay. Now I have included almost everything that you need to be familiar with under inheritance tax, but of course within 1 hour's time I won't be able to discuss everything that you have been given, but I have included everything because you can use this for your reference when you're studying at home. So anyway, this is how the taper relief works. So the taper relief is available on lifetime transfers on the death of the person if the time gap between the date of gift and the date of death is more than 3 years. So this table, you don't have to memorize it. It will be given to you at the exam. And the computation, I will explain in a while. So this is how you do the computation on a lifetime transfer on the death of the person. You calculate the taxable amount, and from on that you take inheritance tax at 40%, 40% on the taxable amount, and from that, depending on the time gap between the date of gift and the date of death, you can claim the taper relief. Then you get an answer, and after that, during the lifetime, that means at the time of making the gift, if you have paid any IHT, at the time of making the gift, if you have paid any IHT, now that will only apply on CLTs because there's no immediate IHT on pets. Potentially exempt transfers do not attract any immediate IHT. Therefore, there won't be any lifetime IHT, but if it is a CLT, there can be immediate IHT. So if you have paid any lifetime IHT, you can deduct that as well. But another important thing to remember is that both taper relief and then lifetime IHT paid can only be used to bring your IHT liability to zero. IHT liability to zero. Both taper relief and a lifetime IHT paid can be used to bring down your liability to zero. However, they can never be used to create IHT refund or IHT repayment. The maximum that you can do with the lifetime IHT paid and taper relief is to bring down your IHT liability to zero. It cannot result in IHT repayment because there's nothing called IHT refunds or IHT repayments. Okay, so you can use them to bring down your liability to zero. So this is a very good summary. This explains whatever the exemptions available on both lifetime gifts and death estates. There are some exemptions and reliefs that are available only on lifetime gifts. Some exemptions and reliefs are available only on death transfers. But some of the reliefs are available on both lifetime transfers and death estate transfers. Death estate transfers. Okay, right. Now, my microphone is working perfectly, so you should be able to hear it. If you don't hear it, it has to be a problem from your side because the majority can hear well. And I check my microphone, so it works perfectly all right. I can see it from my end. If it doesn't work also, I can see it from my side. So there cannot be any issue from this side, okay? Then anyway, thanks Harun. He says working perfectly. So just check from your side, guys, if you don't hear. Okay. Right. Anyway, now coming back. So there are some reliefs available only on death transfers, but only limited number of reliefs. So you can see that's another disadvantage of making transfers on the death of a person, because you have only very few reliefs available, such as QSR, quick succession relief. That is a situation where two people have died at a quick succession. So one person has died and the other person also has died. It's like this. You make the gift to someone, and the person who received the gift also has died within a period of 5 years. So if you have transferred an asset from one person to another person, and both of them had died within a period of 5 years, then you get the quick succession relief actually. So there the rates, if it is 0 to 1 year, then 100% quick succession relief, otherwise 1 to 2, 80%, 2 to 3, 60%, 3 to 4, 40%, 4 to 5, 20% likewise. Now that is not given to you at the exam, so you need to memorize it. Then double taxation relief is there in a situation where you have been taxed in a different country as well. Then there is something called residence nil rate ban. What is this residence nil rate ban? It is a situation on the death of a person. If you give something, not give something, if you give to your main residence, it is the house where you live, on the death of a person, if you give to your main residence to a direct dependent. Who is a direct dependent? Children and grandchildren only. On the death of a person, if that person gives his main residence to his direct dependents, such as children and grandchildren, then you are permitted to claim the residence nil rate ban, and that is only available on the death of the person. But some of the gifts are there only available on lifetime transfers. We learned current year annual exemption, carry forward annual exemption. First, you have to use the current year one before using the brought forward one. I explained about the small gift exemption, the marriage exemption, then I explained about the normal expenditure out of income, then I explained about the fall in value relief as well. Now, there are some questions coming. Yes, Ali, now you're asking, will you be adding us in any WhatsApp group for tutor support? Now that I'm not in a position to create a WhatsApp group. So what I can do is I can give my number, and if you guys can create a group from your side, then you guys can add me, because I don't have any numbers. So this is something organized by ACCA Pakistan. So I'm not sure whether they are in a position to create a group. I can ask with them. If that is the case, they can add me to whatever the group that they create. Yes, I will share my contact guys. So you can add me to any group for this purpose until the exam comes to an end, and you can ask whatever the question you can have in the group. Okay. So here, fall in value relief is also there. Fall in value relief. Now that I explained, because normally if the value appreciates over time after making the gift, you will not be penalized for the appreciation in value. You don't have to pay extra IHT. But if the value falls, you get a relief called fall in value relief. Okay. Then there are some reliefs available both on lifetime gifts and death estate. Now, if I get a chance, I will try to explain this. And when I'm explaining questions, that is business property relief, which has been tested, including agricultural property relief. Now, please go through these two reliefs carefully. These two can be tested. And then, because it's in this limited time period, what I can do is I can explain how to answer a question and the areas that you should focus when you're studying, right? Because it's a vast area. I hope that you understand that. But as I said, later you can ask whatever the questions that you have for clarification purposes. And then we have three types of gifts which are completely exempt from inheritance tax. Memorize these three as well. There are three gifts. It can be during your lifetime, or it can be on the death of the person. On the death of a person, these three are always completely exempt. If you make a transfer to your spouse, to your husband, to your wife, maybe during your lifetime or even on the death of a person, it's completely exempt from inheritance. If you make a gift to a charity, completely exempt from inheritance tax. If you make a gift to a political party, completely exempt from inheritance tax. We call them exempt legacies. We call them exempt legacies. Even if it falls within the qualifying assets for the purpose of agricultural property relief, completely exempt. Business property relief also, it depends. At certain instances, up to 100%, it will be exempt. In certain circumstances, when it comes to quoted shares and all, only 50% will be exempt. So that is something that you need to go through. All right. Now here there is something called, normally, if a UK domiciled person makes a gift to his spouse, his or her spouse, it's completely exempt. If the recipient is a UK domiciled person, if the donee is a UK domiciled person, UK domiciled spouse, then everything will be exempt. But if a UK domiciled individual is making a gift to a non-UK domiciled individual, in that case, everything will not be exempt, only up to 325,000 pounds, it will be exempt. Normally, a UK domiciled individual makes a gift to a UK domiciled spouse, completely exempt. But if a UK domiciled individual makes a gift to his or her non-UK domiciled spouse, only up to 325,000, it will be exempt. It will be exempt. Balance will become chargeable. Balance will become chargeable. Okay. However, coming back to this domicile status, one must remember, unlike income tax, CGT, those two taxes are actually charged on UK residency, UK residence. So based on the residency status of an individual, both income tax and CGT are charged based on the residency status of the individual. But inheritance tax is a tax charged based on the domicile status of an individual. Domicile status basically is a situation where it depends on the country of origin of a person. So if you are a person where you were born in the United Kingdom, or you have settled down in the United Kingdom after leaving another country, so you have migrated to UK, in that case, your country of origin is UK. So then you are treated as a UK domiciled individual. But residency status is something else. Now, if I go to UK and live for more than 183 days in the tax year, even though I'm a Sri Lankan citizen, I become a UK resident individual. I become UK resident. But I don't become UK domiciled just because I spend more than 183 days in the United Kingdom. I may go to UK and work there for more than 183 days in the tax year. I will be treated as a UK resident individual for the purpose of income tax and capital gains tax. But I will not be treated as a UK domiciled individual for the purpose of inheritance tax. I may become UK resident, but my country of origin is Sri Lanka. In that case, I'm not a UK domiciled person. Now, what's the importance of the domicile status? If you are a UK domiciled person, you have to pay inheritance tax on worldwide transfers. But if you are a non-UK domiciled individual, in that case, you have to pay inheritance tax only on assets located in the United Kingdom. So I decided to explain further, and then actually I intend to give you a break for 15 minutes, and after the break I will do some questions actually, right? So let's continue. And when it comes to inheritance tax, always spend some time to learn the inheritance tax computation on share disposals. Share disposals. Always spend time to understand the inheritance tax computation on share disposal. So that is something important. Now, one of you have asked actually the question, explain business property relief. So I will explain these reliefs as well. Now, business property relief is available when you gift a property used in a business. When you gift a property used in a business. Now, the best example that I can give you is you are gifting your unincorporated business to someone. Assume you are running a sole trader, sole proprietorship, or you are a partner of a partnership, and your share in the partnership you give to your children, or you're gifting it to someone else. In that case, you can claim business property relief up to 100%. The whole value of the business will be exempt from inheritance tax under the business property relief. Or else, you have some shares in an unquoted trading company, not an investment company, but an unquoted company. Unquoted company. What is an unquoted company? An unquoted company is a situation where the company is not listed in the London Stock Exchange. If the company is listed in the London Stock Exchange, we call it a quoted company. If it is not listed in the London Stock Exchange, the company would have been listed somewhere else, but not in the London Stock Exchange, then it should always be treated as an unquoted company. So if you are gifting your shares that you have in an unquoted company, 100% of the value will be exempt under business property relief. But if you are gifting shares of a quoted company which is listed in the London Stock Exchange, in that case, it will not be exempt under the business property relief unless you have controlling interest in the company. Unless you have controlling interest in the company. So if you are gifting shares in a quoted company where you have no controlling interest, how can you gain control in a company? For you to gain control, you should own more than 50% in that company. But if you do not have the controlling interest in the company, then you cannot claim business property relief. But if you have controlling interest in the quoted company, and now you're gifting your shares in that quoted company where you have the controlling interest, you can claim business property relief, but only up to 50%. Only 50%, you can't claim 100% in that situation. The other one is, assume you are a partner of a partnership, or else a shareholder who has a controlling interest in the company, and you have given your land and buildings, plant and machinery owned by you to the partnership or to the company where you have controlling interest for the company or for the partnership to use it. Now you give that land and building, you give those plant and machinery used in the partnership. In that case, you can claim business property relief, but again only 50%. So controlling interest is a situation where you have more than 50% shareholding in the company. Okay, right. And to claim business property relief, it has to be a qualifying relevant business property. These are the examples which you need to memorize. And there's another requirement to be satisfied, that is, you should own the qualifying relevant business property at least for a period of 2 years. At least for a period of 2 years. So it has to be a relevant business property, plus it must be owned at least for a period of 2 years. There are certain assets, we call them accepted assets. If the asset is not used in the business for the purpose of trading, then it is an accepted asset. You cannot claim business property relief for that in that situation. Then we have a similar relief called agricultural property relief, but in this instance, the relief is only available on property used for the purpose of agriculture. And when it comes to agricultural property relief, remember, the relief is only available on the agricultural value of the property. Now, this agricultural property is actually having two values. One is the agricultural value, and the other one is the market value or the commercial value available, rather the commercial value. Agricultural value and the commercial value. The commercial value and the agricultural value are different from each other. When an agricultural property is developed, then you get the commercial value of the property. So the difference between the agricultural value and the commercial value of the property is actually the development value. When an agricultural property is developed, then it becomes a commercial property, which has a commercial value. But agricultural property relief is only available on the agricultural value. It is not available on the development value of the property. So any plant and machinery, livestock, crops, farmland or farm buildings used for the purpose of agriculture, on which you can claim agricultural property relief. Here also, the properties must be used for a particular time period, and here the time period based on the person who's cultivating the agricultural property. That is, if the owner of the property is the one who's cultivating the property, in that case, the assets must be owned at least for a period of 2 years to claim the agricultural property relief. However, if the property is farmed or cultivated by an outsider, not by the owner, we call it tenanted farm. If the property is cultivated by a tenanted farmer, in that case, the asset must be owned at least for a period of 7 years for you to claim the agricultural property relief. Then you can see you have the death estate computation. Now, this is different from transfer of lifetime transfers. So when it comes to death estate computation, it's very much similar to the computation of business that you're going to wind up. a business that you're going to wind up. Now, yeah, I will give you the break at Pakistan time at 9:20, guys. Sorry, 9:20. No, sorry. Yeah, 9:30. 9:30. Not 9:30. I'm sorry. I'm making a mistake. Now I started 7:30, 8:30. Yeah, 8:30. I will give you the break at 8:30, guys. Okay. So another 10 minutes time. So anyway, coming back to the topic. Now, when you're calculating the death estate, when you're calculating the death estate, it's like winding up a business. Now, when you're winding up a business, what do? You liquidate the business. You sell all the assets, settle the liabilities, and the remainder will be distributed among the owners of the business. Likewise, on the death of a person, it's a liquidation of an individual. On the death of a person, you need to find out the assets owned by that person who has died. You identify the assets of the deceased person, and from that, you need to deduct whatever the liabilities that must be settled by the deceased person. Now, for the purpose of inheritance tax, there's nothing called exempt assets. All the assets are chargeable assets for the purpose of inheritance tax. So you must include everything when you are calculating the death estate, and from that, whatever the liabilities must be deducted. And then, if you have gifted something, if you have gifted some assets on the death of on your death to your spouse, it is an exempt legacy. You don't have to pay IHT on that. Or if you have gifted something to a charity on your death, it's an exempt legacy. If you have gifted something to a political party, it is an exempt legacy on which you don't have to pay IHT, you deduct everything. Then you get an answer, you call it net free estate. Net free estate. And from that, there is a concept called gifts with reservation. This has been tested a few times at the exam. GWR, gift with reservation. Now, what is a gift with reservation? Due to the limited time that I've been given, I won't be able to explain everything in detail. So you have to excuse me for that. But I'm just trying to explain the important areas that can be tested at the exam. So anyway, now what is gift with reservation? Now, sometimes you make gifts to avoid the higher inheritance tax on the death of a person. Now, Sri is asking an interesting question. What if you have two spouses at a time? Now, unfortunately, unlike in your country, Sri, in the United Kingdom, you can't have more than one spouse. So this problem will not arise, because if you have more than one spouse, then it is a criminal offense. So you will be sent to jail for bigamy, right? So that's you don't have to think about inheritance tax computation in a situation like that, okay? Right. So anyway, I was trying to explain gift with reservation. Now, you make a gift during your lifetime because you know making lifetime gifts will be beneficial than making a gift on your death. Because we learned there are so many advantages of making lifetime gifts. Therefore, what you do is to avoid the higher inheritance tax liability on your death, you make the gift during your lifetime. You make the gift during your lifetime, but you continue to enjoy the benefits from that property. Example, you gift your house to your son. You gift your house to your son, but you continue to live in that house. without paying any rent, or else you gift your shares to your daughter. You gift all of your shares to your daughter, but you continue to receive dividend. You don't allow daughter to receive dividend. You have gifted the shares to your daughter, but whatever the income that you get from the shares, you continue to enjoy. So if you continue to live in that house until such time you die, you continue to receive dividend on the shares gifted until such time you die. Actually, it is not a proper gift. If you make a gift, the recipient should be able to enjoy the benefits out of it. Here you have legally transferred the ownership to someone else, but you continue to enjoy the fruits or the benefits of that property. In that case, it is not a pure gift that you have made during the lifetime. HMRC will not consider it as a lifetime gift. Instead, they will want you to include that value in your death estate computation, though you do not legally own the property at the time of death. The legal ownership has been transferred, but the beneficial ownership has not been transferred until your death. In that case, the value of the property must be included in your death estate computation, though you don't legally own the property. Then you get the gross chargeable estate, and from that, you need to deduct the nil rate band to calculate the taxable estate. Okay. So from the gross chargeable estate, you can deduct the residence nil rate band. That will be only available if the main residence has been gifted to your children or grandchildren, no one else. That's the only situation where you can claim the residence nil rate band. That is gifting your main residence to your children or grandchildren. Then you need to calculate the available normal nil rate band. Then you get the taxable amount. On that, you pay IHT at the rate of 40%. Now for the tax year, RNRB's residence nil rate band is 150,000, and you don't have to memorize it because it will be given to you at the exam. Further, your RNRB can be reduced gradually if the net estate value before any reliefs and exemptions, if the net estate value exceeds 2 million. So if your net estate exceeds 2 million, for every £1, so for every £2 in excess of 2 million, by £1, your residence nil rate band will come down. And then another concept that we have in inheritance tax, that is what we call substantial gifts made to charities. Substantial gifts made to charities. Now this is a special situation where you can apply a reduced death rate of 36%. Reduced death rate of 36%. Now, what do you mean by that? If you have made a substantial donation to a charity, then on the death estate, you have to pay taxes not at the rate of 40%, but at the rate of 36%. So how do you determine whether it's a substantial legacy or not? For that purpose, you need to calculate something called baseline amount. You need to calculate something called baseline amount. How do you calculate the baseline amount? You need to add back to your taxable estate, you need to add back the charitable donation that you have made, and also add back the residence nil rate band 150,000. Then you get an answer to the taxable estate. Say it's 300,000. assume the charitable donation is RNRB is 150,000. I'm trying to get a figure to explain the answer. Assume it's 100,000 pounds. 100,000 pounds. So the baseline amount in that case, 400, 550,000. 550,000. And from this baseline amount, take 10%. From the baseline amount, take 10%. So how much is that amount? 55,000 pounds. 55,000 pounds. If your charitable donation, here charitable donation is how much? 100,000 pounds. Your charitable donation is 100,000 pounds. So if the charitable donation is more than the baseline amount, which is 55,000 here, it's a substantial charitable donation. Then on the death estate, you have to pay taxes only at the rate of 36%. But if the donation made is less than 55,000 pounds to the charity, then you are not entitled to use the reduced rate. You have to pay at the normal 40%. Okay, guys, I'm sorry I won't be able to explain everything. So we'll take a break now. After 15 minutes time, let's start again. And then straight away, I will be discussing some questions with you guys, some past paper questions. So let's take a break for 15 minutes and start in another 15 minutes time. Okay. See you in 15 minutes. Okay, let's start, guys. Now, straight away, since I have a limited time period, what I will do is now I will discuss some questions with you guys. So, I have decided to discuss some questions from the Kaplan revision kit. Okay, so let me see, question number 30 of the Kaplan revision kit. Okay, so Pescara is the name of the question. So this is based on a past paper actually. Now, when you are answering a question like this, first we will look at the marks allocated for this question. Marks allocated for this question. So only 20 marks allocated. So that's why it says calculate your allowed time. Allocate the time to the separate parts also. It's extremely important. Time management is very crucial when you're answering question at the exam. Now for 20 marks, you can take nearly 36 minutes to answer this question. And for subparts also, you need to allocate time and identify time, how much time you require. I always believe that you should first read the required part before reading the information provided in the question. You should always read, in my opinion, if I were you, I will read the required part without first reading the question, because then I know what I'm supposed to do with the information that I'm going to, with the information that I have been given. Calculate the inheritance tax payable. So this is something that I mentioned. They will always want you to calculate the IHT payable, and 7 marks out of 20 they have allocated for that purpose. In respect of Marina's gift of the shares in Sepang PLC as a result of her death. One thing I said, they always want you to calculate inheritance tax liability. And another thing that I mentioned during my theory explanation, that you must be familiar with the inheritance tax calculation with regard to gifting of shares. Then B, Roman 1, calculate Pescara CGT liability for the tax year 2021 on the assumption that C there. Now, this I'm not going to answer here because tomorrow I'm going to explain capital gains tax. So this I'm not going to explain. Then explain how the proposed gift of the UK property will be treated for the purpose of calculating the inheritance tax due on Pescara's death. So A and C I will answer because those two areas from inheritance tax. And one more thing, I told you whenever they ask questions at the exam, they will want you to explain both inheritance tax implications and CGT implications. I repeat again, if the question says explains the capital tax implications, if the question says capital tax implications, even though they have mentioned it or not, remember you need to address both IHT and CGT explanation. IHT and CGT explanation. Right. Now let's read the information provided. Pescara requires advice on the inheritance tax payable, on death, and on the gift of a property, and on the CGT tax due on a disposal of shares, together with relief available in respect of the purchase of seed enterprise investment scheme shares. So I'm not going to explain CGT part. Then Pescara and her parents. Pescara is a higher rate taxpayer. Now these things you have to quickly grab, quickly absorb. It says is a higher rate taxpayer who is resident and domiciled in the UK. So he's a UK domiciled individual for the purpose of IHT and a resident person for the purpose of CGT, which we are not going to touch right now. His father is Galvez, died on the 1st of June 2008. 1st of June 2008. Then Pescara's mother, Marina, died on 1st of October 2020. Both Galvez and Marina were resident and domiciled in the United Kingdom. So that makes the question less complicated. All are UK domiciled individuals. Then Galvez lifetime gifts and gifts on death. This is Pescara's father. Galvez had not made any lifetime gifts. In his will, Galvez left cash 80,000 to Pescara and further 80,000 to Pescara's brother. Okay. Galvez left the remainder of his estate to his wife, Marina. Marina lifetime gifts and gifts on death. On 1st of February 2015, Marina gave Pescara 375,000 shares in Sepang PLC. So the first question was actually about this Sepang PLC. Marina had made no other lifetime gifts. Marina gift of 375,000 shares in Sepang PLC to Pescara. On the 1st of January 2012, Marina purchased 375,000 shares for 420,000. On the 1st of February 2015, Marina gave all of the shares to Pescara. The shares were quoted at 184 to 196. The highest and the lowest market bargains were 180 and 192. The shares did not qualify for business property relief or CGT relief, so that is also very clear. Acquisition of Sepang PLC by Zolder PLC and subsequent bonus issue. So what has happened? Now the first question is about calculate the inheritance tax payable in respect of Marina's gift of the shares in Sepang PLC as a result of her death. So she gifted on the 1st of February 2015. Okay, so let's straight away, let's answer the question with the information that we have been provided with. Now, I will use a spreadsheet because it will be easier for me to do the computation. Bear with me, guys, until I get this sorted. Okay, right. I will use a normal Excel sheet, but as I mentioned previously, you need to practice questions using the normal, because I can do it side by side. So that's why I'm actually using this one to explain the answer. Right. Okay. Now, Marina's lifetime gift. She made a gift, Marina. Need to calculate the transfer of value. Need to calculate the transfer of value. Now, for the purpose of inheritance tax, when it comes to gifting of shares during the lifetime, how do you calculate the transfer of value? For that purpose, we are using a special valuation method. We are using a special valuation method actually. So here, for this purpose, how do you calculate the transfer of value? I'll take this as a working number one. You have to take the lower of 1/4 of method, 1/4 up method, 1/4 up method, or average of the bargaining prices. Average bargaining prices. From the two amounts, you have to take the lower amount. Now, here, Marina gave all of the shares to Pescara. That happened when? The date of gift, 1st of February 2015. 1st of February 2015. Okay, 1st of February 2015. And that is during the tax year 2014-15. Identify that. And what is it? It is a potentially exempt transfer also. It's a potentially exempt transfer. Potentially exempt transfer. Now, to calculate the transfer of value when it comes to shares, the rule says you have to take the lower of 1/4 of method or the average bargaining prices. There is a list price, quoted or list price, and then you have the bargaining prices. Now, the average of the bargaining prices, how do you calculate? Highest and the lowest, 180 and 192. So what you should do is 180 is the lowest, at the highest 192, add them together and divide it by 2, you get the average bargaining prices or the mid price. That is 186. You can do your computation and say it's 186. And then 1/4 up method, how do you do the computation? You take the list prices or else the quoted prices and you take the lowest price, that is 184, the lowest list price, that is 184. To that amount, you take 1/4 of the difference between the highest and the lowest. 192 is the highest. From that, deduct the lowest, 180. So the difference here in this instance is 12 pence divided by 4, 3 pence. And that amount you add it to the lowest price, there you get 187. 187. Now from the two amounts, which one is the lower? 186. So 186 is the lower amount. Then when you're calculating the transfer of value, you need to do the computation based on 186. So how many shares that you have gifted? You have gifted 375,000 shares. Now I will use a formula to get the answer. 375,000 shares you have gifted, and that must be multiplied by 186. 186. Then you get an answer 697,500. That is your transfer of value. So this is the only gift that she has made during her lifetime. Anyway, from this, there are no special exemptions available, but you can deduct the annual exemption. You can deduct the annual exemption here. The current year one, current year means 2014-15 annual exemption, which is £3,000, and then you can deduct the previous year annual exemption also, because you have not made any other gift. So the previous year one is now carried forward from 2013-14. There you get another £3,000. So when you deduct, you get an answer that is 691,500. This is the chargeable amount. And this is the gross figure, as it is a potentially exempt transfer. It's a potentially exempt transfer. Therefore, this is the gross chargeable amount, and there is no immediate IHT on this value 691,500. On this amount, there's no immediate IHT, as it is a potentially exempt transfer. However, this 691,500 will become chargeable if the donor dies within a period of 7 years. Marina made the gift on the 1st of February 2015, and we need to look at the date that she died. So if she has died within a period of 7 years from the date of gift, then this 691,500 is going to be chargeable. So Marina died on the 1st of October 2020. Date of death, October 2020. 1st of October 2020. So you can see Marina has died within 7 years from the date of gift. Therefore, this 691,500 becomes chargeable. So the donor has died within 7 years from the date of gift. Gross chargeable amount 691,500 will become chargeable now, since the donor has died within a period of 7 years. Then from this, now you're doing the calculation due to the death of the donor. Marina has died. So we are doing the calculation due to the death of the person. So the gross chargeable amount is 691,500. From this, you can now deduct the nil rate band. Now you can deduct the nil rate band. Now I'm going to explain something extremely important. Now here you need to consider the nil rate band available at the time of Marina's death. Nil rate band at Marina's death. Now I need to add. Okay. Nil rate band available at the time of Marina's death, that is during the tax year 2020-21, because she died on the 1st of October 2020 during the tax year 2020-21. It's 325,000. 325,000. Okay, 325,000. Now, this is the important thing. During my theory session, I did not explain this, but a commonly tested one. That is, if one spouse has died without utilizing the full nil rate band available, the unused percentage of the nil rate band can be transferred to the other spouse who has died second. So if a spouse has died without fully utilizing the nil rate band available, any unused percentage of the nil rate band can be transferred for the second spouse to use on his or her death. So we need to check whether Marina's husband, that is Galvez, has died without fully utilizing the nil rate band available. So Marina died second, that is after the death of Galvez. Galvez died on the 1st of June 2008. Marina died after that in October 2020. Now we need to check whether there is any unused nil rate band available to Galvez. Then we can transfer that to Marina on her death. Now, Galvez has not made any lifetime gift. However, Galvez has died while transferring cash 80,000 to Pescara and another 80,000 to Pescara's brother. So when did he die? Okay, so this is an important computation that we need to do. So this I take as working one, and now I'm going to do working number 2. That is to find out the unused nil rate band transferred to Marina on the death of Galvez. Now, Galvez died in the tax year 2008-9, 1st of June 2008-9. That falls into 2008-9. Okay. Then we need to check here, the calculator is also there. We need to check the tax table. So we need to find out the nil rate band available for the tax year 2008-9. Here you can see 2008-9 tax year starts when? 6th of April 2008 to 5th of April 2009. 6th of April 2008 to 5th of April 2009, it is 312,000. So from the tax table, I gathered the information required. It is 312,000. So at the time of Galvez's death, the nil rate band available was 312,000. 312,000. Now he has not made any lifetime gift. So he has not used the nil rate band for his lifetime gifts. So then on his death, he has made a gift of cash, 80,000 to Pescara and another 80,000 to Pescara's brother. Everything else you have left to, he has left to his wife, Marina, which is an exempt legacy. So that means from this 312,000, for the chargeable estate, that is 80,000 into 2, cash 80,000. One is to Pescara, the other one is Pescara's brother. Okay, so that is 160,000 pounds. 160,000 pounds you will have to use against your nil rate band. You have a nil rate band of 312,000. On your death, you have given 80,000 to Pescara, another 80,000 to Pescara's brother. So from your nil rate band available at the time of death, you will have to use 160,000 against the nil rate band. And the balance nil rate band you don't have to use is unused nil rate band. That is because from your death estate, everything else other than this 160,000, everything else you have left to your spouse, which is an exempt legacy. Therefore, you don't have to pay IHT. You don't have to use the nil rate band. Therefore, 152,000 is the unused nil rate band on the death of Galvez, 152,000. This you have to take it as a percentage. If you take this as a percentage of the total nil rate band, 152,000 is the unused amount. As a percentage of the full nil rate band available into 100%, you get 48.718%. We'll keep it to 3 decimals. Yeah, 3 decimals. 48.718%. So that means out of the nil rate band available, 48%, 48.718% was not or was unused on the death of Galvez. So this can be transferred to Marina for her to use it at the time of her death. Therefore, in addition to Marina's nil rate band, so any unused nil rate band of your spouse can be transferred to the second spouse for her or for him to use it on the death of that person. So there's an unused nil rate band of 48%, 48.718%. That can be transferred to Marina for her to use it on her death. So that means Marina has her own nil rate band. Yes, Fatima, now you're asking a question. Can the nil rate band be transferred even after any amount of years? Definitely yes. It doesn't matter how many years it had taken. So if your first spouse has died without using the full nil rate band, the unused percentage can be used to the second spouse for her or him to use it on his or her death. So at the time of your death, you have 325,000. In addition to that, you can use unused percentage of Galway's nil rate band. How do you calculate it? What you should do is, at the time of your death, at the time of Marina's death, the available nil rate band is 325,000. That answer must be multiplied by 48.718%. 48.718%. So 325,000 into the unused percentage. You should use the nil rate band available at the time of your death, and to that figure you have to apply the relevant percentage. So then you get 500 80,000, 558,333. 158,333 is the answer. Okay, so that means the total nil rate band available. Total nil rate band available is 483,000, 333. Now normally what you do is you have to go back. Now in this situation, when you click on this, you can see the way you have done the computation. So it doesn't matter, you have to don't have to show each and every computation if it appears on the formula bar for the examiner to check. Okay, right. So you can use this formula when you're doing your computation. So you have 483,333. So this includes Marina's nil rate band as well. Marina's nil rate band is 325,000. In addition to that, she was able to use her husband's nil rate band, which was 158,333. Altogether, 483,333 is the nil rate band available. And this person, Marina, has not made any other lifetime gift. So even though you go back 7 years from the date of gift, nothing is left. Therefore, you get the answer. This is going to be your taxable amount. Taxable amount is 208,167. So this is your taxable amount on which you must pay inheritance tax. Now the IHT is at the death rate 40% on this. So 208,147 into 40%. That is 83,267. And from this, don't forget, you can deduct the taper relief. You can deduct the taper relief. Now, the taper relief depends on the time gap between the date of gift and the date of death. So the date of death is 1st of October 2020, and the date of gift is 1st of February 2015. So count the number of years from the date of gift to date of death. So 16 February, 17 February, 18 February, 19 February, and then 20 February. So the time gap between the date of gift and the date of death is 5 to 6 years. 5 to 6 years. The time gap between the date of gift and the date of death is 5 to 6 years. So normally, now there are some questions. The platform that you have to use in a CBE exam, computer-based exam, you don't get to choose. Along with the question, they will give you the spreadsheet. Normally, that is how it works in the skills level. So there, if you get to choose, then you can even do your explanations on the Excel sheet. But normally, it's inbuilt. So if it is a question where you have to do computations, in that case, it will be a spreadsheet. But if it is an explanation, there will be a Word document on which you have to write the explanation. So it's inbuilt. You don't get to choose in that case. You have to just use whatever you have been given. So 83,267. So the taper relief is based on 5 to 6 years. That is the time gap between 5 to 6 years. So as a percentage, how much? 5 to 6 years means 5 to 6 years, 60%. 5 to 6 years, 60%. So from 83,267, 60% you can claim as the taper relief. You can claim as the taper relief, that is 49,960. And then you get an answer 33,307. If you have any lifetime IHT paid, you can deduct it. But since it's a potentially exempt transfer, you cannot have lifetime IHT. And finally, you get your inheritance tax payable, IHT payable, 33,307. 33,307. Okay. Right. So this is the answer for part A actually, to secure 7 marks. So not bad. Here the learning points were calculating the unused nil rate band of your spouse, and the other one was calculating the inheritance tax payable. And to calculate the transfer of value, we have to use a special formula, that was the lower of 1/4 of method using the list prices, and the other one was average of the bargaining prices. So there was another question that was section C. Section C. Explain how the proposed gift of the UK property will be treated for the purpose of calculating the inheritance tax on Pescara's death. That's something else here. Explain. So you don't have to do any computation. You just need to address the key principles, key rules pertaining to gift of this UK property. Let's look at the nature of the property. Pescara intends to give a UK property to her son on the 1st of October 2021. Pescara intends to continue to use this property rent-free such that the gift will be a gift with reservation. Now, can you see? During my theory class, I explained how the gift with reservation works. So that is the explanation that you have to give. No computation required. You just have to explain how it works. And you can easily secure 4 marks by answering the question. But let me explain some additional things. Now, Pescara intends to continue to use this property rent-free such that this gift will be a gift with reservation. So you don't have to waste your time to explain what a gift with reservation is, because the question specifically states the information that you've been provided specifically states it is with a gift with reservation. So you don't have to explain how it is going to be a gift with reservation. Already decided it's a GWR, gift with reservation. So you need to explain the inheritance tax implications on this gift with reservation. Now, Pescara intends to gift it on the 1st of October 2021. She intends to gift this on the 1st of October 2021. 1st October 2021. Now I'm going to explain the tax implications. Now, this is a gift made by Pescara during her lifetime. She's not dead now. So this happened during the tax year 2021-22. And what is it? It is a potentially exempt transfer. Under normal circumstances, it should be treated as a potentially exempt transfer. Potentially exempt transfer. Then you take whatever the transfer of value, deduct the annual exemption, and calculate the gross chargeable amount in the usual way. Gross chargeable amount in the usual way. You calculate the gross chargeable amount in the usual manner. Now, anyway, since it's a pet, no immediate IHT. No immediate IHT. However, since it is a gift with reservation, there is an alternative computation that we need to consider here. Under normal circumstances, it is a potentially exempt transfer, which has a gross chargeable amount and no immediate IHT. So from the date of the gift, which is 1st of October 2021, if the donor dies within a period of 7 years, if the donor gives the asset, from the date of death, if the donor dies within a period of 7 years, if the donor dies within a period of 7 years, then this pet, this gross chargeable amount becomes chargeable. That's a normal situation. You made a gift during the lifetime, it's a pet, no immediate IHT, but if the donor dies within a period of 7 years, the gross chargeable amount becomes subject to inheritance tax. However, since it's a gift with reservation, we need to do another computation. And that depends on, so here donor dies within 7 years. Gift becomes chargeable. This is a normal situation. Listen very carefully. Yeah? However, since this is a gift with reservation, there's another special computation that you have to do. There's another special computation that you have to do. What is that special computation that you have to do? And that depends on two situations. That depends on two situations. One, if donor lives or if donor uses the asset until his death, until his or her death. And the other situation, if donor leaves prior to her death. These are the two situations that you have to explain. So if it is a gift with reservation and the donor continues to live in the premises without paying a rent until such time she dies, in that case, outcome is included, it should be included in the death estate computation, included in the death estate, included in the death estate, and pay IHT at 40%. IHT at 40%. But there can be situations the donor is not going to, she's not going to live in that premises until she dies. Before that, she leaves the premises and moves to somewhere else. So at the time of her death, she's not using it. Prior to that, she leaves the premises. Now there you have to be cautious because it's a special thing. So if the donor leaves the premises or stop enjoying the benefits prior to her death, at that time should be treated as deemed pet. It should always be treated as pet, deemed pet, deemed potentially exempt transfer. Example, assume she leaves, now she made the gift on the 1st of October 2021, and assume she leaves the premises prior to her death on the 15th of November 2023, made the gift on this date, but she continued to live in the premises. However, she decided to leave the premises on the 15th of November 2023 prior to her death. In that case, on the 15th November 2023, it becomes deemed pet. It becomes deemed pet. So you can see for the same gift, you have two dates now. The date you actually made the gift, on that date also there was a pet, and the date she actually stopped using this gifted asset for her own benefit. That is 15th November 2023. The gift became a pure, genuine gift on the 15th of November 2023. Therefore, HMRC will want you to consider this date and this date both and do two separate computations and calculate the inheritance tax liability and pay the higher amount. So now what you should do is on the 1st of October 2021 also you take, that's a normal gift, within 7 years if the donor dies, you do an IHT computation on the potentially exempt transfer, and then you do another potentially exempt transfer computation if the donor dies within 7 years from 15th November 2023, and you get two amounts. You don't have to pay both the amounts because then it will be double taxation, but from the two amounts, HMRC will want you to pay the higher amount as IHT payable. If you continue to use the asset until such time you die, then it will be included in the death estate and you pay at 40%, and you do the normal computation as usual, thinking it's a potentially exempt transfer, compare the two amounts and pay the higher value. Pay the higher value at the end of the day. So this is how gift with reservations work. This is how gift with reservation works. Okay, right. Now, let me move to another question. Let me move to another question. Yes, Matusha. Now, Matusha is asking a question. Now, some of the questions are not relevant to what I'm explaining. So if the question is about what I'm explaining right now, I will take my time to answer. Other questions, I may try to answer during the session if I have time, or else what you can do is towards the end, I will give you my number. So you can message me. I will try to answer those questions. Now, Matusha's question is relevant to what I'm explaining right now. However, if the donor dies after 7 years, obviously the gift will become fully exempt. So from this date, if the donor dies within 7 years, it will be exempt. And from this date also, if the donor dies after 7 years, it will be exempt. So that is how it works. Right. And so let's try another question quickly because we have a little more time now. Let's look at question number 31. So if you look at the previous question again, this is another question. Now, the date you actually made the gift, we have to transfer the legal ownership, but not a PO gift on that date. On this date, there's a normal pet, so this one date. So if the donor dies within 7 years from this date, the gift will become chargeable, but HMRC will want you to do another computation based on the date where the gift became an actual or genuine gift. According to my example, I assume that he left the premises on the 15th of November 2023, though he legally transferred the ownership on the 1st of October 2021. So this is the date of gift where the legal ownership was transferred. But HMRC under gift with reservation, under anti-tax avoidance rules, they will want you to consider this date also as a date of gift, where it became a genuine gift. So based on the two dates that you are having, you will have to do potentially exempt transfer computation if the donor dies within 7 years from this date. One computation, get the answer. If the donor dies within 7 years from this date, do another similar computation based on the value exist at the time of this date. And from the two amounts, you take the higher value. If the donor continues to stay in the house until he dies, in that case, the value of the house should be included in the death estate, calculate IHT payable on the death on the house, and assuming it was a normal gift, calculate the IHT liability from the two amounts, you pick the higher and pay that to HMRC. So here you are not required to do any computation. You just have to explain how it works. So let me now answer the next question. Let's look at this question as well now. I think some of the questions that you're asking, you can send it to me later, right? Because I'm trying to do another question now. Okay. Now, the one question using a calculation, it will take some time, but doing a calculation, I'm telling you, is not important. Most of the time, the exam, they ask you to explain how it works. So that will be enough actually, right? More than doing a computation. So let me quickly answer this question as well. CADA, what do we have to do? The required part. Explain the inheritance tax advantages other than lifetime exemptions which could have been obtained if CADA had made additional lifetime gifts of quoted shares between 1st December 2016 and her death. Now, this is what I mentioned during my theory explanation. That is, the advantages of making lifetime transfers. But in this question, they have put some restrictions when you're doing your explanation. That is, the question says, explain the IHT advantages other than lifetime exemptions, which could have been obtained if CADA had made additional lifetime gifts of quoted shares between 1st December 2016 and her death. So you don't have to explain about the small gift exemption, annual exemption. You will not be given marks for that. You will not be given marks for that actually. So what you have to do here is explain the advantages other than the exemptions available that you can obtain. But anyway, for that we have to read the question. Calculate the increase in the legacy to charity which should be necessary in order for the reduced rate of inheritance tax. This is what we call substantial charity donations. That is to claim the reduced rate of 36%, something that I explained on the theory. And quantify the reduction in the inheritance tax liability which should result. Explain capital gains tax and inheritance tax advantages which could be obtained by varying the terms of CADA's will, and set out the procedures required in order to achieve tax effective variation. So this is what we call a deed of variation. Deed of variation, that means changing the last will after the death of a person, is possible for the purpose of inheritance tax and CGT to get certain benefits. In relation to capital gains tax, so I'm not going to explain D, but I'm going to explain A, B, and C. So A, let's read the question. I think about the platform, whatever the question that you're asking, first, now I'm here to explain the subject. So platform is applicable to any other subject as well. So what you should do is it's freely available. You go, there are questions, attempt the questions and see how it works. So without attempting, you will not be able to understand anything. And then you will be able to familiarize yourself with the options available. Okay. So that can save a lot of time, but otherwise you can after that kind of questions once the session is over. Thank you. Right. So here your firm has been asked to provide advice in connection with inheritance tax and CGT following the death of CADA. The advice relates to the implications of making lifetime gifts, making gifts to charity, varying the terms of a will and other aspects of CGT planning. CADA and her family, UK domicile, died 20th November 2020. CADA is survived by two daughters, Raymer and Yang. Raymer has an adult son. Yang has no children. CADA lifetime gives an available nil rate ban. CADA had not made any lifetime gifts since 30th November 2016. So CADA, date of death, will identify the important information, date of death. That is 20th November 2020. And then she has not made any lifetime gifts since no gifts since 30th November 2016. Okay. Carda's nil rate band available at the date of her death was £220,000. Right. So to answer the first question, information that I read, enough. They're enough for us to answer the first question. Explain IHT advantages other than lifetime exemption which could have been obtained if Carda had made additional lifetime gifts of quoted shares between 1st of December 2016 and her death. 1st of December 2016 and her death, 20th November 2020. So if you make a lifetime gift between 1st of December and her date of death, 20th November 2020, say you give quoted shares, it will become, one impact is, it will become chargeable on the death of Carda for sure. So if you make a gift of shares between 30th November 2016 and 20th November 2020, it will definitely become chargeable on the death of Carda because it's within a period of 7 years. If you made a gift after 1st of December 2016, and since Carda is going to die on the 20th November 2020, within a period of 7 years, one impact is definitely it's going to be chargeable. One impact is it's going to be chargeable. Chargeable as within 7 years. But disadvantage, however, IHT will be calculated based on the value exists at the time of gift. At the time of gift, not at the time of death. Not at the time of death. Okay? So, any increase in value after the gift, an increase in value will be ignored. But fall in value relief will be available. Fall in value relief will be available if the value decreases. If the value decreases. What else we can mention? Taper relief. Taper relief available. Taper relief available. Taper relief will be available if the time between date of gift and death more than 3 years. Now they have allocated 4 marks to this question. Therefore, it is advisable to, like, explain or have at least 3 to 4 points to get the answer. Okay. And at the same time, since it's quoted shares, now you can claim the business property relief, but the business property relief will only be available if you have control in this company. If you have no control in this company, business property relief is not available on quoted shares. Even then, you can claim a maximum of 50%, right? So anyway, you have a available nil rate band also in this situation, which you can use. So this gift will become only chargeable if the value of the gift exceeds 220,000. So anyway, there's an available nil rate band 220,000. So the value of the gross chargeable amount of the share transfer should exceed 220,000. Then only it becomes chargeable. Now let me explain the next part, the computation part. Calculate the increase in legacy to the charity which would be necessary in order for the reduced rate of inheritance tax. So that is calculating the baseline amount to see whether you can claim the reduced rate of 36%. So let's look at that aspect. Kada owned assets valued at 1 million at the time of her death. Kada left her house valued at 500,000 to Raymer. Okay. Now let's look at that part as well. Okay. House, 500,000 pounds. So I'm going to consider two situations here. I have a very limited time, so let me try to explain it quickly. Before additional gift, before additional gift. Before additional gift, and then let's look at after additional gift. I'm going to make a comparison. So they are asking, forget about the after additional gift, just look at what we have been given. Before making any additional gift, the house goes to Raymer, to your son. So direct descendant, in that case, you will be able to claim the residence nil rate band. And then 60,000 to UK National Charity. Kada left cash 60,000 to UK National Charity. So cash to charity, 60,000 pounds. It's an exempt legacy, but first we will calculate the total estate. Left her remaining assets, including a portfolio of shares valued at 440,000 to Yang, to the daughter. So the residual, the remainder, 440,000. So there you get 1 million. There you get 1 million. So this is the breakup. And from this, less exempt legacy, that is to charity donation, which is 60,000 pounds, So when you do that, you get a balance 940,000. From this, now house goes to whom? House goes to his son. That's the main residence. So if the main residence is gifted to your children or grandchildren, you can claim RNRB, residence nil rate ban. So the value of the house is 500,000. So you can claim the full residence nil rate ban, 150,000 pounds. And then you can claim the normal nil rate ban. According to the question, the nil rate band available at the date of her death is 220,000 only. The full amount is not there according to the question. The only amount which is available is 220,000 pounds. So after everything, you have a balance of 570,000 pounds. So this is what we call the taxable estate. This is what we call the taxable estate. Now, before paying IHT, or before calculating IHT at the rate of 40%, you need to check whether you are in a position to use the reduced IHT rate of 36% if you have made a substantial charity donation. So you need to check whether this 60,000 is a substantial charity donation. We need to check whether this is a substantial charity donation. For that purpose, you need to calculate the baseline amount. Baseline amount. How do you calculate the baseline amount? For this only, you should know the equation. Baseline amount equals the taxable estate. Taxable estate is how much? Baseline amount. I'll explain like this, then it is easier for you to remember. Taxable estate. Taxable estate. 570,000 pounds. To that amount, you add back. You add charity donation. You add back charity donation, which is 60,000 pounds. And then you add RNRB as well, residence nil rate ban, which is 150,000 pounds. Then you get a total amount of bear with me, guys. Little more, okay? I'll finish it soon. Okay, got the question. So 780,000. So take 10% of 780,000. 780,000 into 10%. How much is that? 780,000 into 10%, you get 78,000. But for you to claim the reduced rate of 40%, reduced rate of 36%, you should make a minimum charitable donation of 78,000 pounds. A minimum charitable donation of 78,000 pounds for you to get the reduced rate of 36%. But in this instance, your charity donation is only 60,000 pounds. Therefore, it's not a substantial charitable donation. The current one is 60,000, which is less than 78,000 pounds. Therefore, it's not a substantial charity donation. You have to pay IHT at the rate of 40% on this 570,000, which is 228,000. So your liability is 228,000 pounds. Then we have to make a comparison. What if we make a substantial charity donation? 60,000 is not enough to come under substantial charity donation. You need to make a charitable donation of 78,000 at least. Therefore, other than this 60,000, for you to claim the reduced rate of 36%, you need to contribute an additional gift of 18,000. 60,000 is not enough. You have to make at least 78,000. Therefore, you have to increase the exempt legacy to 78,000. So after charitable donation, I can quickly get the answer in this way, and then we can complete it. So we have, actually I can get the answer in 1 second. I'll quickly get the answer. It's simple when you're using this formula. Actually, rather than facing a paper-based exam, this is a very simple way of doing it. So all the other things remain the same, but in this instance, your charity donation will become 78,000. Then your estate will become 922,000. All the others available 552,000. However, in this instance, your taxable estate would be 552,000. However, since you have made a substantial charity donation, you don't have to pay taxes at the rate of 40%. You can pay taxes at the rate of 36%. So then your liability would be 198,720. 198,720. So that means there's a reduction in IHT liability by how much? Reduction in IHT liability. Under normal circumstances, you would have paid 228,000, but due to the substantial charity donation, you have to pay IHT 198,720. So reduction in IHT liability is 29,280. However, to get this benefit, you have to sacrifice 18,000 pounds, because now you have to pay additional payment to charity. Additional payment to charity is 18,000 pounds. Is 18,000 pounds. So you get a benefit of 29,280 because your IHT liability reduces by that amount. But to get that benefit, you need to sacrifice 18,000. So your actual tax saving, but still there is a tax saving of 11,280. 11,280 would be your tax saving. To calculate the IHT liability, yes, Matusha, I took 78,000 to calculate the IHT liability after making. So it's an exempt legacy, so I deducted that amount, got 922,000 and deduct the normal residence nil rate band and the nil rate band available. So the taxable estate was 552,000, and now you pay taxes at the rate of 36%. At the rate of 36% in this situation. Okay? Right. Yeah, so the time is actually up, but I'll quickly explain the next part also, that is the change of last will. I will explain it. I'm not going to type the answer. Now, normally when someone has written the last will, after the death of the person, can you change it? Obviously, then you can't call it a last will. However, under special circumstances, for the purpose of inheritance tax and CGT only, you can change the last will after the death of a person. That is what we call, and after the death of a person, only for the purpose of inheritance tax and CGT, you can change the last will. For you to change the last will, you have to write a deed. We call it deed of variation. For you to write a deed of variation, remember, for you to write a deed of variation, all the parties who are affected by the deed of variation must give their consent. It should not happen for a value. There shouldn't be any consideration. There shouldn't be any consideration, and all the parties who are affected by the deed of variation must give their consent. And when you're writing the deed of variation, you have to specifically state that this is only done for the purpose of, this is only done for the purpose of inheritance tax and CGT only. You cannot change the last will for any other purpose. For any other purpose. And the deed of variation must be in writing, and it should happen within a period of 2 years from the death of the person. From the death of the person. It should be in writing by way of a deed of variation, should happen within a period of 2 years from the death of the person, and all the parties who are affected by the deed of variation must give their consent, and it should not be for a particular value or consideration. And the other thing is, it should specifically state that the deed of variation is only applicable for the purpose of inheritance tax and CGT. So let's stop at this point. I wish I had more time because it's all these topics are very long, but I have shared the materials for you to go through leisurely. I have shared some questions with answers for you to attempt leisurely at home. And the other help that I can do is I will share my WhatsApp number on the chat box. So you can ask whatever the questions that you have, depending on the time availability. I will answer your questions. So now I'm going to share it. Share my number with you guys. So now I have sent. I hope that it's there. Yeah. So okay, right. Nice to hear that, Hina. Anyway, let's again meet up tomorrow. Tomorrow I'll be discussing some questions with regard to CGT at the same time, Pakistani time, 7 o'clock, 7 to 10, Sri Lankan time, 7:30 to 10:30. So let's stop at this point. See you tomorrow. Until then, take care, guys. Good night.